Hello everyone, welcome back to our channel. In today's video, we will learn treatment of capital asset in the books of accounts, especially how to expense out the capital asset. As we know, Gara Electronics had purchased furniture amounting to rupees 10 lakhs for the purpose of commencing business. If you remember, the entry passed was as follows. Over here, when we paid the money, instead of recording expense, as we did when money was paid for purchase of TV set or electricity bill, we recorded the same as in another asset under the name of furniture. So in short, we have transferred 10 lakhs from one form of asset to the other form. Now after 5 years, that furniture got rusted, and let us assume that Jethalal decided to replace the same with a new one. So he called a scrap dealer, and the dealer offered 1 lakh rupees for that furniture. Jethalal was very happy that even after using furniture for 5 years, he would still get 1 lakh from it. So he decided that he would go ahead with the same. Now while passing entry, one big difference was observed. Value of furniture when it was purchased was 10 lakhs, and value at which it is sold will be 1 lakh. So there will be a gap of 9 lakhs standing in furniture account. Now where to put this 9 lakhs? So Jethalal decided to expense it out. So he opened one nominal account under the name usage expense, and he debited that account with 9 lakhs and simultaneously credited the asset account. After charging 9 lakhs, Jethalal suddenly realized that he has made sale of 4 lakhs only for this year, and after charging this expense, his loss would be 5 lakhs. Whereas cash spent on this 9 lakhs was at the time when furniture was purchased. So basically, 2 years books of accounts have been prepared erroneously. Also, for 5 years, Gara Electronics have recorded sale, and for 5 years it has also used this furniture in the business. If you remember the matching concept, all the income shall have its corresponding expense. So recording this expense right at the end of 5th year means books of account made in between 1st to 5th year is also in violation of matching concept. So Jethalal was completely confused, and he immediately ran to his CA for help. On analyzing the scenario, the chartered accountant gave one solution to him, that is, to spread the cost of furniture over the period of usage. Now what does that mean? In Gara Electronics case, furniture's cost was rupees 10 lakhs, and the period of usage was 5 years. Hence, 2 lakhs shall be expensed out each year in order to display correct picture of business through books of accounts. By doing this, in 5th year, instead of booking loss of 9 lakhs, only 1 lakh would be required to be booked. Now you're wondering how? Well, cost of asset at the beginning of 4th year would be 2 lakhs, and 1 lakhs would be received from the scrap dealer. So in the final year, there will be only a loss of 1 lakh. Now this method of spreading cost of any asset over its period of usage is known as depreciation. And there are multiple ways in which this cost can be spread out. But the most common method is straight line method and written down method. And there is a very simple difference in both the methods, which will be learned in the next slide. Now, straight line method, as the name suggests, is simply charging the cost of asset over its period of usage. Whereas, in written down method, a fixed percentage is charged on value of asset at the beginning of the year. Now if we apply both the method in Gara Electronics case, let's see the difference. Under straight line method, cost of furniture is 10 lakhs and its usage is 5 lakhs. So depreciation per year will be 2 lakhs, that is 10 lakhs divided by 5 years. Now similarly, if we check the other method, that is written down method, cost of furniture remains the same, that is 1 lakhs, Over here, rate of depreciation, let us assume, will be 10%. So depreciation per year would be 10% of asset of value at the beginning. So on first year, depreciation would be 0.90 lakhs and so on. Also, one thing is to be noted that under straight line method basis, value of asset would be 0 or equal to the scrap value at the end of usage period. Whereas in the written down method, value of asset will never be 0 or will never be equal to scrap value. Now we will see the calculation of depreciation for 5 years under both the method. Under straight line method, cost of asset at the beginning of first year is 10 lakhs and we know that depreciation per year is 2 lakhs. So the value of asset at the beginning of each year will automatically be reduced by 2 lakhs each year. Whereas under written down method, depreciation is computed by applying fixed percentage on the value of asset at the beginning of the year. So depreciation each year would keep on decreasing as you can see in the table. And towards the end of the period, asset value is 0 under the straight line method, whereas under the written down value, assets value will be 5.9049 lakhs. And this is a major difference under both the methods. Now, how will you record the depreciation? Over here, again it can be done in two ways. One way is to simply open a new ledger under the name of depreciation and charge the amount directly from asset. Depreciation is a nominal account, hence to record the depreciation, following journal entry will be passed. Depreciation will be debited as it is recording expense of business and asset will be credited as that is porting of value is going out of business. Next, another way will be that we can open two ledgers, depreciation account, which is again nominal account, and provision for depreciation, which is real account. So over here, the journal entry would be depreciation account debited as expenses recorded and provision for depreciation credited as it records those value which is about to be going out of the business. Same way as we have recorded for the ICICI Bank if you have seen the earlier videos. In this method, asset account is intact and no entry is passed through it. When we will dispose of the asset, two new nominal accounts will be opened, which would be profit on sale of asset if cash receipt from asset sale is more than the value of asset. And on the other side, loss on sale of asset of cash receipt if asset sale is less than the value of asset. Now how will you pass the entry? When the asset is disposed of, if we charge depreciation directly from asset, then it is very simple. Cash would be debited as it comes in the business and asset account would be credited as it is going out of the business. Profit on sale of asset will be credited if cash received is more than the outgoing asset, which will reflect extra income, and loss on sale of asset will be debited if cash received is less than the outgoing asset, reflecting extra expense beared apart from annual depreciation. On the other hand, if provision for depreciation is created for passing depreciation entry, then journal entry would be cash account debited as it comes in, asset account credited as it goes out, provision for depreciation debited as it goes out, loss on sale of asset debited if cash value is less than asset value, and profit on sale of asset credited if cash value is more than asset value. Hope you have got the basic logic of depreciation clear and why it is so important for business. In case you have any doubts or you want any solutions for any question, do mail us in the mail ID mentioned below. We will definitely make a solution video and post it on our channel for your better understanding. Do like, share and subscribe for more videos. Thank you.